Hey everyone, this is Kirk here again at optionalpha.com, and this is the trading alerts video for members here. And I want to go over the closing and opening trades that we had here today for the 17th of December. It was a little bit less active than yesterday. Yesterday we had 11 trades in total, which was a pretty active day for us as far as opening new trades and closing out. And today was a little bit more balanced, just happened to be where the market kind of ended up at the end of the day. I actually had a couple orders that had been canceled throughout the day, so I'm going to try to get those in tomorrow. Was looking to enter some more trades today, but just didn't get the right pricing on some of the spreads that we were looking at. So I want to go over two of the butterflies that we actually closed out today and walk through why we closed these out, because we're getting close to December expiration. It's only a couple days away now, so because these butterfly spreads have pretty much gone as far as they're going to go, we don't want to take any chances with them coming here to the end of December expiration, being in the money or out of the money. So I want to go over both of those here today, and then we'll talk about some of the verticals that we entered today with high implied volatility on the MA trade, and then just a nice VIX trade as well. So first one that we want to talk about is XOP. We actually had bought this butterfly originally for I think around one something, around 160 something, I think, and we sold it back to the market here today for 210 as far as a credit. And really what we did is we did a very wide butterfly in terms of strikes because our strikes were at 73, 68, and 63. So again, very wide strikes, about 5 points away on each end of the butterfly here. And that's an even butterfly. It's not an unbalanced or broken wing butterfly. It was just a pure volatility play. Volatility in XOP had been really, really high when we originally bought this butterfly. And so we wanted XOP to stay right around our middle strike here at 68, or kind of right in that wheelhouse, I guess, right in that neighborhood for us to make money. So when you actually go to the chart and take a look at where XOP ended up trading, let me just zoom in here a little bit too. Volatility continued to stay high, and for the better part of all of December, except for these last couple of days here, XOP actually traded right around that 68 number that we were looking for, and that's exactly what we wanted to do. Implied volatility was high, we just wanted to be range bound. Over the past couple of days, it started to move outside of that range, and again, our lower strike is down here at 63, so we do have some room. But at this point, we want to take what money we have on the table. It could easily continue to move lower over the next couple days as we hit this December expiration. So at this point, we made some great money on the trade. It was a nice butterfly trade. It was great taking advantage of some high implied volatility, but we're going to close out the trade and just move on to the next ones. All right, so the other one that we got rid of is the EEM, and this was the remaining butterfly that we had after a broken wing butterfly that we had originally entered. So what happened is, and if you go back through some of the video tutorials, I think I posted one on there that's going to be public now. So you're watching this, it's on our YouTube page. Definitely going to be public as far as the broken wing butterfly. But we originally had a broken wing butterfly on EEM where we had skipped the strike in the put section. And what we did is actually bought back the embedded call spread in that so that we basically got a totally free butterfly at the end of the day. And again, go over that video tutorial. I'll go over it in detail, so check it out on YouTube. But now we had this embedded call spread that we had on for free. It didn't cost us any money, so it was pure profit. And all we need to do is kind of wait till very close to expiration to exit the trade. And again, you can see our strikes are at 42, 41, and 40. So very even, and again, pinned right at 41. Well, today we go to the chart and we close out this trade for a nice little credit of 30 cents each. And we go to EEM, and you can see that we are right pinned around that 41 level on the charts. 41's right here, and that's exactly where we kind of pinned it. So that's what we want to do. We want to take advantage of it. We've been kind of waiting, and it's been teasing us a little bit all month, but we've been kind of waiting for EEM to come back down to this 41 level as far as price. That's right in the middle of where our strikes are. Again, our higher strike is up here at 42. The lower one's all the way down here at 40 below off the chart. But right here at 41 is where it's at, and that's where we close out the trade. Take advantage of most of it right now. If it starts to go either way in the next couple days, again, same thing that you run the risk of with XOP is that it just goes out of the market and we can't take advantage of it. All right, so let's talk about new trades that we entered today. We went over some of the closing trades that we had. Great trades, took in some great profit, which is always good. The new trades that we went over today, or that we entered today, is we had added to our vertical put position on the VIX. We just moved strikes. We originally had the 1614, and we still have those 1614 puts, but now we've added the 17.15 put spread because the VIX continued to trade higher. So again, the midpoint on this is 16, so we really want the VIX to trade really kind of below 16 heavily by January expiration. So I think that's very doable. I don't think that that's far stretched at all. The VIX has been trading anywhere up to and north of 17 and then just continues to run back. So we've had 3, 4, 5 incredible days here on the VIX as far as moves. So I think it's very likely that, again, any time between now and January expiration, we get a move lower in the VIX. We're going to take advantage of it and just take that trade off the table. HLF, same type of story here with Herbalife as far as a move down. Just had a nice little pop up today. Implied volatility is not that high on Herbalife right now, but we did want to take advantage of it with just a simple put spread. So again, we bought the 77.5 strike and sold the 75 strike. We paid $130 for the debit per spread. So it's going to be a nice, fairly even balanced trade. Again, we'll go to the charts and take a look at Herbalife. HLF. You can see it had a nice pop here earlier in the day, and we had sold it kind of near the highs here today. So it was a nice move in Herbalife, but we do think it's kind of overbought a little bit right now. Starting to see some profit taking come into place, and we've kind of reached the same 77, 78 level before, and Herbalife has had a really tough time pushing past that level. So I think it's going to be a pretty massive area of resistance, and I think some profit taking is also going to help. All right, so finally we sold a vertical in MA, and we sold the 770, 765 put spread for $1.10 credit. Now I'm going to go to MA, which is MasterCard, and you can see that MasterCard has been on a tear over the last couple months here. It's just been going nonstop straight up and has even gapped open here in December. And so we could have easily sold the call spread on this as well. But the reason I sold the put spread is because it gives us a little bit more room to the downside. So again, our strikes are right down in here, so that gives us much more room to the downside. And considering the gap up, you don't see gaps too much in stocks. And so when you do see them in stocks like MasterCard, which is really heavily traded, you want to take advantage of those and know that you want to trade in that direction, at least for the time being. So I think MasterCard could come back down a little bit. There's going to be a little bit of profit taking, but overall, I think the trajectory is going to continue to be a little bit higher for MasterCard going forward. So in this case, it was just a decision that we made to either sell the call spread or sell the put spread. Again, you can do both. They both have the same statistical chance of being success or a loss. So as long as you look at your strikes accordingly and know where your probabilities are, then you know where the market can and can't go on the call side and put side. But for us, we took advantage of the puts, and we want to sell that put spread. I'm actually going to go to the actual trade tab here for MA real quick and show you guys exactly, and you can see the put position that we have right now. It's right down here on the bottom, so this is no joke. This is a live position that we put in here today. And I'm going to scroll all the way down to the strikes that we entered here today and show you guys exactly where the probabilities are. So again, we sold the 777, bought the 765, and you can see those two strikes are right here. And right here is the probability that we're working with. We really always want to target kind of this 30% level. And that's really what I target with these vertical spreads is a 30% chance of loss, so 70% chance of success. Not a high probability of success. We're not trading 90% probability of success because there's just not enough premium left in those trades. But this is a pretty good trade, and this is usually what we make as far as the credit that we take in for the width of the strikes. And so you can see that I know right now that at the 770 level, which is where our first strike is, that I have a 30% chance of losing on this trade, meaning I have about a 70% chance of winning on this trade. So those are where my positions are placed. You could easily move down here and go to the 20% level, meaning that you have an 80% chance of success. It's really up to you what you want to do. Now on the top side, you can see that you just have to be a little bit more cautious on where you place the trade. It's not that it's going to be an even distance away from the market. You can see that on the top side with the call spreads, the 30% level is as far as a probability of loss, so 70% chance of success, starts at 820 as far as a strike. So if we were selling the call spread because we thought that MasterCard was overbought with this gap up, we could have sold the 820, 825 call spread. And that would have been the same type of probability trade on the call side as on the put side. So again, strategy over direction. Direction is important and obviously can make a difference, But at this point, all we're doing here is making high probability trades. It doesn't matter if it's on the call side or the put side. You could easily do an iron condor on this if you wanted to, but we just wanted to stick to one direction and make Herbal, see if MasterCard can move a little bit higher here while volatility contracts. So hopefully you guys enjoyed this. That was helpful to go over some of the actual trade tabs and some of the numbers here as far as probabilities and pricing. I've got a lot of questions about that, so I'm going to start going over that a little bit more in detail on these videos. But as always, if you guys have any questions or comments, please ask below in the members section here, and I'll get to your answers right away. Happy trading, and we'll see you guys tomorrow.